Auto-sweep facilities in banking have gained significant popularity over the past decade, especially in regions where maximizing returns on idle funds is a priority for both individuals and businesses. At first glance, these facilities appear to be a savvy tool for ensuring that excess funds sitting in your savings or current accounts earn higher interest, much like a fixed deposit. However, beneath this alluring promise of convenience and better returns, there are intricacies and risks that often go unnoticed. Understanding these hidden traps is crucial for anyone considering or currently using auto-sweep facilities. To begin, let's clarify what an auto-sweep facility actually is. Essentially, an auto-sweep facility is a banking feature that links your savings or current account to a fixed deposit account. When the balance in your primary account exceeds a certain threshold, the surplus is automatically transferred, or swept, into a fixed deposit, where it earns a higher rate of interest. Conversely, if your account balance falls below a preset level, funds are reverse swept back from the fixed deposit to cover the shortfall, thus helping you avoid penalties for insufficient funds. On paper, this sounds like a win-win scenario. You get the liquidity of a savings account with the higher returns of a fixed deposit. But as with many financial products, the devil is in the details. One of the primary risks lies in the fine print, specifically the terms and conditions that govern the auto-sweep arrangement. Many account holders are unaware that the interest calculation on the swept amount may not be as straightforward as a traditional fixed deposit. For example, when funds are reverse swept to cover a withdrawal, banks often break only the most recent, or the last, fixed deposit created through the sweep. This means that if you have multiple sweeps, only the latest one is liquidated, regardless of which has the highest value or has earned the most interest. As a result, you might not maximize your potential earnings. Moreover, the interest rate applicable to swept funds may sometimes be lower than the advertised fixed deposit rates, especially if the tenure of the sweep deposit is shorter. Some banks only offer the higher interest rate if the swept funds remain untouched for a certain minimum period, say 7 days or more. If your funds are frequently swept in and out, you could end up earning much less than expected. Another risk involves premature withdrawal penalties. If your auto-sweep facility reverse sweeps funds back from the fixed deposit to your savings account, it may be considered a premature withdrawal. Many banks levy penalties or reduce the interest rate for such withdrawals, further eroding your returns. This is particularly problematic for customers who maintain only a small margin above the sweep threshold, resulting in frequent sweeps and reversals. In addition to these financial risks, there is also the matter of tax implications. Interest earned on swept fixed deposits is taxable, just like any other fixed deposit. However, because funds are frequently moved in and out, tracking the exact interest earned and corresponding tax liability can become complicated. Many account holders inadvertently overlook this, leading to potential issues with tax compliance. Another often overlooked risk relates to liquidity. While the auto-sweep facility is designed to enhance liquidity, the process of reversing a sweep is not always instantaneous. Depending on the bank's internal processes, there may be a delay, sometimes up to 24 hours, before the funds are available in your account. In an emergency, this lag could cause inconvenience or even result in bounced payments if your account is debited before the reversed funds arrive. Then there are operational risks. Not all banks are transparent about the rules governing their auto-sweep facilities. Some may impose minimum balance requirements, hidden charges, or service fees for activating, maintaining, or terminating the facility. Others may have less than ideal customer support, making it difficult to resolve disputes or clarify ambiguities. Furthermore, auto-sweep facilities may not be suitable for all types of account holders. For instance, businesses with highly variable cash flows could experience frequent sweeps and reversals, leading to confusion, reconciliation headaches, and potentially lower net returns due to penalties and suboptimal interest rates. Similarly, individuals who rely on their savings account for regular transactions may find that the constant movement of funds complicates their record-keeping and budgeting. Another subtle risk is the psychological trap of perceived liquidity and returns. The promise of higher interest on idle funds can sometimes encourage account holders to keep larger balances than they otherwise would, under the impression that their money is working harder. This could inadvertently lead to missed opportunities for deploying funds in more productive investments, such as equities or mutual funds, which may offer better risk-adjusted returns over the long term. Let's also consider the technological risks. As banking becomes increasingly digital, the systems that manage auto-sweep facilities are not immune to glitches or errors. There have been instances where technical faults have led to incorrect sweeps, delayed reversals, or even double withdrawals. While such occurrences are rare, they underscore the importance of regularly monitoring your account statements to ensure that all transactions are executed as intended. Security, too, is an important factor. Because auto-sweep facilities operate automatically, any unauthorized access to your account, through hacking or phishing, could potentially exploit the feature to siphon off funds rapidly. While banks have robust security measures in place, the auto-sweep mechanism adds another layer of complexity that could be targeted by sophisticated attackers. Given these risks, how can an account holder make the most of auto-sweep facilities while safeguarding against potential pitfalls? First, it is essential to thoroughly read and understand the terms and conditions associated with the facility. Pay special attention to the interest calculation method, sweep thresholds, premature withdrawal penalties, and any applicable charges. Don't hesitate to ask your bank for clarifications or a detailed breakdown of how the facility operates in practice. Second, monitor your account activity closely. Regularly review your statements to ensure that sweeps and reversals are occurring as expected and that the interest credited aligns with your calculations. If you notice any discrepancies, raise them with your bank promptly. Third, consider your cash flow patterns before opting into an auto-sweep facility. If you tend to maintain a stable surplus above the sweep threshold, you are more likely to benefit from the higher interest rates. However, if your balance frequently fluctuates around the threshold, you could end up paying more in penalties and charges than you earn in extra interest. Fourth, be mindful of tax implications. Keep detailed records of the interest earned on swept deposits and ensure that you declare it in your annual income tax return. If you are unsure about the tax treatment, consult with a financial advisor or tax professional. Fifth, don't let the existence of an auto-sweep facility lull you into complacency about your broader financial plan. While it is a useful tool for maximizing returns on idle funds, it should not be viewed as a substitute for deliberate investment planning. Always evaluate whether your surplus funds might be better deployed in other instruments that align with your risk tolerance and financial goals. Finally, stay vigilant about security. Update your banking passwords regularly, enable two-factor authentication where available, and be cautious of phishing attempts. The convenience of automated features should not come at the cost of compromised account safety. In conclusion, auto-sweep facilities are an innovative banking solution that can help maximize returns on idle funds while retaining liquidity. However, like many financial products, they come with their own set of hidden traps and risks. Understanding these risks, ranging from suboptimal interest calculations and premature withdrawal penalties to tax complications, operational challenges, and security vulnerabilities, is vital for making informed decisions. By approaching auto-sweep facilities with a discerning eye, carefully evaluating the terms, and staying proactive in your account management, you can enjoy the benefits of this feature without falling prey to its potential downsides. Remember, what appears to be a simple tool for boosting your savings can quickly turn into a financial labyrinth if not navigated wisely. The key lies in balancing the allure of higher returns with a clear-eyed assessment of the associated risks, ensuring that your hard-earned money continues to serve your best interests, both now and in the future.